You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Here we go. 3, 2, 1. Welcome back to Options Insider Radio, the interview program here on the old network where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we hope so, Options Insider Radio Network. If we sound a little bit different, it's because we're coming to you not from our studio in Chicago, but from scenic and indeed sunny Florida, where we are attending the Options Industry Conference, a great event. It gives us a chance to really catch up with a wide variety of people from all throughout the world of options, including our next guest. He is a newcomer to the network. He is John Davidson, the president and COO over there at the OCC. John, welcome to the program.
Thank you very much. It's great to be here, and we really appreciate the work you do for educating investors on options. They are a very important product with a fair amount of risk that needs to be understood, and the work you guys do is really terrific in that regard.
Well, we try. We try to fight the good fight, John. It's hard, but we try. John, as we are wont to do with a lot of our first-timers here on the network, why don't you go ahead and give us a little bit of an overview of your background in the options and derivative space and how you found your way over there to OCC.
Sure. Well, I've now been at OCC for, on Tuesday, it'll be exactly a year. Although previously in my career, I was on the board of directors of the Options Clearing Corporation from 2002 to 2006. I started my career at the Chicago Board of Trade building in 1980, working for Merrill Lynch Commodities, actually. Moved from there to what was then the not yet demutualized Chicago Mercantile Exchange. Ran the clearinghouse at the CME for 10 years, including through the stock market crash in 1987. I was recruited away to bring my Chicago-born wife and 2 kids kicking and screaming to New York to work for Morgan Stanley, eventually running all of their global institutional operations. Came back to the then post-IPO CME Group in 2006 for a couple of years. You can tell I'm really bad at market timing since I missed all of these
years,
opportunities.
plus or minus everywhere, would have been perfect.
And then just to really put a point on that, I joined Citigroup in 2008, in April of 2008, not really understanding what I was getting myself into. Working in the risk management division for a couple of people, including Vikram Pant, the CEO, who I'd worked with at Morgan Stanley earlier. Retired from Citi in January of 2017 and saw this opportunity to come work at the OCC, which has a number of important initiatives to get through, and thought I could add some value there.
Sounds like that was a short-lived retirement there, John. I guess fishing and golfing didn't agree with you.
Did not happen. Did not work too well for me. No.
But that career trajectory, it sounds almost inevitable that you would end up at OCC at some point or other. So took you a while to get there, but I'm glad you're finally there. Well, you mentioned you have a number of initiatives that you're working on. You guys are clearly busy over there at OCC. Let's start with kind of overhauling the full platform. I know that's kind of falling under your purview as the COO over there. Walk us through kind of how far along you are in that process and what's involved in that.
Sure. Well, Encore is our clearing system. It is actually a very tightly integrated clearing and risk management system. It is very resilient, and it is essentially volume insensitive. Obviously, as the central counterparty, we have no ability to control the amount of volume that the exchanges bring us every day, so we have to have those characteristics. But it is 20 years old. It's old mainframe DB2 technology for the most part, and it is not particularly flexible. So supporting some of the innovative new products that a number of our exchanges would like to bring to market is something that takes us longer than it really ought to. And obviously providing the kinds of services, mainly through APIs, that our clearing members really expect is not where it needs to be. On the other hand, we are a so-called SIFMU, a systemically important financial markets infrastructure. So we have to make sure that not only we clear all of our 20 million contracts every single day, but we do that in a very robust and reliable way. At the same time, as we replace the system, we have spent a lot of time working with a number of potential vendors in the clearing and settlement space. Our previous 3 iterations of a clearing system at OCC, Encore prior to that was something called Intrax, and the one before that didn't actually have a name, were all home built. And we think there are a number of advantages to home building, and we will certainly do our development of some of the key modules in the replacement system, particularly those that manage risk and calculate the margin requirements for the very sophisticated portfolios that our market makers and clearing firms bring to us. But a lot of clearing is just nuts and bolts, very straightforward, has to be flexible, has to have a great deal of capacity, needs to meet the needs of our clearing members, including reflecting a number of enhancements that we've made to Encore over time. We're getting close to making a final decision about who to move forward with on the vendor space. We'll do essentially a proof of concept, which will probably take us through most of the summer, understand the detailed requirements to build, which parts to build, which parts to buy going forward, and should be in a position to go to our board and get approval to actually start the development process in the early part of the fall. Likely to be a 3-year process before we're in a position to really shut down all of legacy Encore. We will do it in a way that minimizes any impact on the inbound messages we receive from the exchanges we support, also the outbound messages that we send to clearing members, but there's a tremendous amount of work ahead of us.
You know, it's funny, we've had a lot of brokers and vendors cycling through here over the last few days, and they're always talking about things like APIs and everything else because they have to be on the bleeding edge of tech. You know, it's part of their job essentially. But you don't expect to hear that from a clearer. But at the same time, you know, it makes sense. You have to interact with all these various counterparties who I'm sure are demanding this of you, right? They want you to be on the same or a similar technological level as them. So it makes sense that maybe a 20-year-old platform wouldn't be cutting it for them. So I'm glad to hear that OCC is making that next step.
Yeah, we don't want to be on the bleeding edge, but we'd like to be a good bit closer to the leading edge than we are today, and it's exactly right. You know, the technology is really enabling the ability to take a lot of cost out of the post-execution part of the processes, and that's fundamental to making sure the options business stays profitable both for the exchanges, our clearing members, and very importantly in options markets, our market maker community.
Now, you mentioned the platform overhaul. Another overhaul you did very recently in the last few years was, of course, the big symbology initiative that took forever to unfold. And I was curious, is that pretty much done? Was that a finite thing, or is there constant evolution on the symbology front? Because people are always inquiring to us, why can't we have a symbol for this? Why can't we have something like that? So is that something you're constantly looking to improve as things are going on at OCC?
Well, I think the symbology initiative itself is in sort of a steady state. But absolutely, there are. I mean, that's the magnificent thing about the capital markets in the United States. They are the most deep and liquid in the world. There's constant innovation. There's constantly new companies IPOing, coming to the marketplace, and we need to continue to support the standardized symbology. We have another related but also challenging issue that we're starting to confront, although there's a bit of a path ahead, and that's with the vast proliferation in series. So there are a relatively constant number, say 4,800 classes, but between regular quarterlies, monthlies, now weeklies, some talk about dailies, there are well over 950,000 different instruments. But only a small portion of them trade with any sort of frequency at all. And everybody in the industry has to maintain the entire inventory. So that's really a significant cost in terms of overhead. It is currently a function of the exchanges. They are the listing organizations. We are the issuer of all securities options in the U.S. But we're getting to the place where the exchanges are willing to acknowledge that this overhead really is not helpful for market makers. It's not helpful for a retail investor who has to call up their financial advisor and figure out exactly what's available to trade and what they want to do. So I think we're going to get to some agreement on at least trimming the tails of these massive listings of series, and perhaps reducing the overall number fairly significantly. So that's not the same thing as the symbology initiative, but it's very similar, and it's one of these sort of infrastructure plumbing needs that the industry really needs some help on.
You know, it's been interesting because obviously a theme at this conference has been liquidity, and we've been taking the pulse of everyone who comes through here about their thoughts about what is causing the liquidity issues, or if they even believe they exist. And the people who are concerned about it have pointed to a number of different factors. One of the ones is the one you just brought up, the fact that there are so many, an infinite number almost of series. You have, the industry has really embraced weeklies in the last few years, so everyone has trended shorter duration. So now you have a 1 month contract that is split into 4, and if you have multiple, you can have up to 8 in some of these series. And so you're right, and it's been driven by customer demand. People want those, but at the flip side, not everyone's trading every strike, and so these poor market makers are quoting all these things, and of course the spreads are going to be wide. The displayed size, they can't be, sizable on all these things. So you're right. A lot of people have pointed to that as being one of the causes. So it sounds like you're taking some proactive steps. You mentioned kind of removing some of those symbols. Would that be, effectively delisting them? Would that be maybe turning them into RFQ? Like, what are you guys thinking in terms of trying to dial that back a little bit?
Well, I think the RFQ possibility is up to the exchanges and the market makers, obviously. If there is real demand for particular series, then, of course, the exchange and the market maker will look for a way to meet that. But just having all of these series out there for the sake of having them doesn't make a lot of sense. There needs to be a way to really dial down the excess noise in order to enable a better focus of the liquidity. I would say in general, the liquidity in the options markets is we have very deep and liquid markets. The problem really, though, is that depth and liquidity is limited to a fairly small number of names. So in the order of 80 to 85% of the daily trading volume is in about 12 underlying securities. And there's great tight markets in those. But what capital creation is all about is not what's the next bid and offer in Facebook or an existing well-established company. It's what's out there for a new entrant into the market and a particular part of the capital market structure that's not as frequently in the press, and making sure that we have market makers that have the capacity to get out there. And sure, those spreads are going to be wider because the risk is greater for those. But enabling that kind of focus as opposed to, well, you know, I have this obligation, I have all these various series and expiration dates. We think concentration in an intelligent way is something that the industry really needs to promote.
You know, you're right. I've been banding about the 20 number. You made it sound even worse with 10 to 12 numbers names doing the vast majority of the flow out there. You know, that's been an issue that's been brought up at this conference a number of times over the years. You know, Henry does his presentation every year, and he always talks about the concentration in there. So we've been hearing that for some time. It hasn't been trending in the right direction. What do you think we could do as an industry maybe to try to bump that number up to, you know, it used to be 50, it used to be 100. What do you think we can do to maybe broaden the pool of the concentration of liquidity beyond those 12 to 20 top names?
Well, there are quite a few things, actually, and our new chairman of the Securities and Exchange Commission, Jay Clayton, is quite interested in this, as is the new director of Trading and Markets, Brett Redfern. The point they made recently at the Security Traders Association meeting in Chicago was that if you think about the 4,500 equity securities that trade on any of the underlying cash markets in the United States, there are several thousand of those that trade less than 100,000 shares a day. And does it really make sense to have a monolithic market structure that says these 2,500, 3,000 stocks that trade less than 100,000 shares a day need to be multiply listed on all 54 equity trading venues, counting ATSs and dark pools? Or can we have some sort of a bifurcation in the market where the deep, well-traded underlying equity securities have that very intense competition that exists today, but maybe the issuer of a more lightly traded security gets to decide, well, I actually think it only makes sense to list my particular stock on one or two exchanges. And obviously the issuer would make that choice. And then you can concentrate that liquidity, and the different exchanges can perhaps have somewhat of a different specialization in particular market sectors, for example. And then I think if that happens, and there may be, according to Mr. Clayton, a possible pilot program in that later in the year, that enables the options industry to follow suit and perhaps think about different ways to have a market structure that really enables some of these more lightly traded securities and their overlaying options in a more rational way. And that really is very helpful to the market makers. The market makers in options are really the most important player in the marketplace. And unlike the cash equity securities business, which is really a facilitation business, the broker-dealers are bringing buyers and sellers together and facilitating a transaction. In options, well over 85% of the retail client orders, in fact, the client orders of all types, have a market maker on the other side. And so the ability of market makers making sure that we're taking the appropriate actions to protect them, making sure that, as my guest Congressman Randy Hultgren has been working on, that the capital regulators for banks appropriately move us past the current exposure method, which doesn't recognize the offsetting risk in a market maker portfolio and charges really excessive amounts of capital for those positions. All of those things are things that will really help the liquidity in terms of broadening it out and having a larger number of underlying securities and their associated options with some significant market volume.
I'm glad to hear the SEC is awakening some of those facts. Sounds like there's some interesting changes on the horizon. As you mentioned, a large part of your job is interacting with Washington as well. In fact, you're doing my job in a little bit. You're interviewing a congressman in a little bit here at the conference. What are some of the topics? You mentioned the bank capital rules. Those are clearly a top of mind for a lot of people here at the conference. Quite a few people have brought those up over with us over the last few days. What are some of the other topics you plan to bring up, and what are some of the pressing issues you're dealing with in Washington right now?
Well, the congressman is actually the vice chair of the Capital Markets Subcommittee of the House Financial Services Committee, and so he really is a very strong advocate in Washington for our industry. And he's actually a former financial advisor. He has Series 7, Series 63, and one other FINRA registrations to his name, so he
should
knows
effectively know what a call and what a put is. So he's ahead of the game already.
He absolutely knows his puts and his calls and his underlying stocks, and he is working very hard. And he's a Republican congressman, but he is one of the most bipartisan members of Congress, and working very hard on getting some legislation. This is a regulatory bank capital rule and international standard. But it looks like Congress is interested in helping the bank regulators move that ahead a little more rapidly than they would perhaps do it of their own accord. Obviously, the tax reform proposal was very important, and the industry did a lot of work in Washington related to the tax changes, mostly trying to make sure that there were no negative to the options industry tax proposals floated. And very happy to say, with the work that the coalition did, they were able to avoid some frankly silly tax proposals and keep them out of the process. Obviously, the change in the regulatory environment is important to the industry. We're getting to the point now where both the Commodity Futures Trading Commission and the Securities and Exchange Commission have a full panoply of members, and we can move ahead a number of the issues that are important to the industry. For the OCC itself, we have a number of regulatory rule changes in front of the SEC. That process is not as smooth and, shall we say, streamlined as we'd like it to be. So we work quite actively with the various staff in trading and markets, trying to make sure they understand which of the pieces of the puzzle are the top priority and which they can wait a while on. We've got a very important proposal which we hope in the next month or two will be published for public comment, related to how we calculate the requirements in our clearing fund. At the end of the day, our risk waterfall for the OCC is first based on very stringent membership standards to become a clearing member, and we monitor our clearing members very carefully. Next are their margin deposits that they put up with us every day based on the risk of their portfolios. And then there's the mutualization of risk through the clearing fund, that all of the members contribute proportion to the size now of their margin requirements, which we think ought to be changed to be really a function of the stress testing results on their portfolio. So that's in front of the commission now. They've asked us some very useful questions about it, and we're working quite actively with them to work that through the process.
You know, I'm always fascinated by the environment in Washington, particularly as it pertains to this industry. I know for a while there, they weren't too receptive to some of the needs and issues, or even understanding of some of the needs and of this industry. It sounds like, you know, from certainly this congressman and the SEC chairman, that things are starting to change. Are you seeing that when you deal with Washington? Are they more receptive to what you're talking about there? Are they starting to understand that there are these needs and these issues, and they need to be addressed, and they don't just see, you know, derivatives lumped together as some sort of red meat issue they can really, you know, sink their teeth into, but something they actually could work and affect some change?
Yes, absolutely. And I think the very refreshing thing about Washington for our industry is there have been some very strong professionals appointed to the various financial regulatory agencies, including the bank regulators. The Fed is our sort of supreme overseer. And the other handy thing is all of those financial regulators, even up through the Treasury Department, have been able to sort of stay below the radar of all the nonsense that's going back and forth and with tweeting this and tweeting that. And that actually lets them get their job done in an active way. And Congress is trying to be helpful there as well. So I think there's definitely a breath of fresh air. Certainly the Dodd-Frank and the other international versions of that reform after the financial crisis did recognize the importance of central counterparties, clearinghouses, if you will, and the exchange-traded markets with their very high levels of transparency, enormous liquidity, and long-standing backing. We date back 45 years. We were established in 1973, actually, of having a clearinghouse for the markets is a very important contributor and one which is now extending into the over-counter derivative market. So I do think there's a lot more rationality, a lot less noise, maybe because the world's been distracted by these other things, which is just fine. Let us work on making sure the capital markets in the United States continue to be the most advanced, the most deep and liquid in the world.
I can certainly get behind that, John. Well, I'm glad we can finally get you on the program here, John. But before we go, if there's maybe anything we didn't get a chance to touch on, or perhaps you want to leave our listeners with a little hint, a little peek behind the scenes of what's coming down the pike from you and your team over there at OCC, now is the time. The floor is yours.
Sure. Well, one of our very important initiatives is continuing to grow our market share in securities lending clearing. That's a very good opportunity, we think, for the industry to get the benefits of the capital efficiency of clearing. And again, I think the importance of education. These are markets that are deep and liquid, but the number of option strategies that are out there can be complex, can be confusing, and making sure that we have very well-educated investors is really critical to the ongoing success of our industry and making sure that we don't have any big issues with people not having the appropriate disclosures of the risk and understanding of the markets in which they invest.
Well, John, you got me excited talking to you here. I'm looking forward to how some of these initiatives play out in the marketplace in the coming months.
Great. Well, thank you very much. Really appreciate the opportunity.
Thank you.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.